So let's start with the US markets. What should we be reading into the drop that we're seeing at the moment?
It's clear that this is the result of market correction, and it has been, this is the seventh day that we saw the stock market has been tumbling down, and that's when the investors are pricing in the concern, the uncertainty, and the fear over this COVID-19. So we know for the stock market, the short term is about the market sentiment, the medium term is about the liquidity, and the long haul is about performance. So right now, the market sentiment is pretty negative.
So let's talk about some of the companies that are taking the biggest hit and those that are doing well, not just in the US, but Europe, Asia, Africa, and the rest of the Americas.
Right. So, it's pretty clear that a wide range of companies and sectors are affected negatively by this uncertainty. And I think the ones that are hurt the most right now are some of the financial and some of the health related companies, because these are mostly affected by the market sentiment and also the confidence about how this global health crisis is going to go. But you also find companies that are in travel related, retail businesses, energy, and also tech companies that are also affected by the demand shock and then the disruption in the global supply chain due to the virus and the quarantine measures.
Now, we did hear about some health companies doing well. Are there any other sectors that are doing well, unfortunately, in this situation?
Right. I think the health sector is a mix, right? So the companies that are related to more so vaccines and are doing okay, but we also see some pharmaceutical companies and also some diagnostic companies are not doing that great. So I think overall this is going to have a far-reaching impact on many different sectors, the service sectors, travel-related sectors, and many of other ones will be affected. And it really depends on how the market is going to react in the next couple weeks, and also how the epidemics is going to evolve. But if we look back to the history in the other episodes of epidemics like this, is that the market typically fell pretty strongly and abruptly, but they also rebound pretty quickly. So hopefully we'll see some of that reversion pretty soon.
So then, given what we've seen from past outbreaks and how the markets have reacted, what sort of short and long-term strategies are companies looking at to try and limit the damage for now?
This is a great question. So I think really, in times like this, usually in the short run, I think the best idea is to really stay put, hanging there and try to ride it out. And I think that works for companies and also for individuals, really, unless you have immediate need for cash, which is the case, for some of the highly leveraged margin call buyers, and they have to liquidate some of the assets in order to come up with cash for to meet the margin costs. But otherwise, I think the strategy is let's just ride it out. Like I said in the past, markets typically rebounded pretty shortly after the peak of the virus, usually between 1 month and 3 months. And over the long run, diversification is always the key. That said, I do think this time around we see the market reacting in a much faster and much more, much stronger reaction. In the past, in the SARS episode in 2003, the market took a whole 3 months to lose the value of 10%. And this time around, it took us 7 days to lose about 12% of market value. So it's pretty concerning.
Right.
The short-term adjustment is going to be very severe.
And obviously, this is giving people sort of flashbacks as to the drop that they saw during the global financial crisis. What are the biggest differences, though, and what are you seeing in terms of the safe havens?
Right. Well, this is a great question. I think, one thing that we do see is the current, market correction is the worst since the global financial crisis. But back then, things started with the financial sector. So people could look for some other sort of alternative assets, trying to secure themselves. But this time around, I think this uncertainty is very far-reaching. It's very overarching. So it's difficult to really find that safe haven. Treasuries is usually what people look to when in times like this. Gold actually right now has down by 3% in the value because, again, investors had to liquidate to get the cash to meet margin costs. So I think, again, the idea is that we need to just stay put and trying to get through this short-term adjustments.
And just very quickly, we have about 20 seconds here. A lot of investors, including Warren Buffett, said even before this outbreak, the market was due for a correction. What should we be keeping an eye on as this continues to unfold?
Yeah, so if you remember just a week ago when the virus was still very rampant in China, the stock market was actually rising. So people were overestimating and over enthusiastic about the market. So I do think we're going down from that very high point, the record high stock market performance. So I think, again, being rational, trying to really look at the fundamentals, looking at the performance of the companies, as opposed to really ride on the bandwagon for the short-term trading.
All right, thank you so much. Yan Liang there, Associate Professor of Economics at Willamette University.